Which shares should you have in your portfolio when the markets go down?
Our market's going down at the moment.
At this specific moment, I can't tell you because I'm sitting next to you, but they have been going down this week.
Yeah, but if you look at the S&P 500, it's on the same level as the beginning of January.
Yeah, and the Nasdaq was 13,500. It is now 12,000. It's almost down for 11%.
Yeah.
And 2 consecutive days for 2.8%.
So we can say that markets are going down the last weeks.
Are going down, yes.
Yeah, and then we're going to discuss in our team what's hot, which shares should you have in your portfolio when markets are going down.
Yeah, exactly.
But first we are looking back.
Yes, what happened?
What happened? And OPEC, they had a meeting yesterday, the OPEC Plus, and in those meetings they do it now on a monthly basis. They decide what they're going to do with the oil production, and they said we leave it on the same level. That's positive. So the market, the oil prices jumped directly 5%.
Yeah.
And the biggest oil companies in the US, they jumped 4%.
They had a really good Thursday session. Yeah. Absolutely.
And also, there's a lot of people are talking about inflation. And normally, a good hedge against inflation is gold. But what do you see? Gold is also going down at the moment.
Exactly, and that was what we see in the chart of the week. So you can see in the screen now that the XAU US dollar, gold versus the dollar, is going down. And we see clearly a negative trend already started at the beginning of this year.
Yeah.
And then in the next chart, so we saw the trend going down of the gold dollar, and then in the next chart I've added the 10 years US Treasury, and you see it's very curious that they follow each other. So the interest of the US Treasury is going down, and it's exactly the same pattern as what we see with gold dollar.
That's strange.
It's strange, yeah, but apparently it happens a lot of times, and this is an important indicator for investors.
And the gold is now trading just below $1,700.
Yeah, correct.
Intel was in the news because they were fined by a judge in Texas for $2.2 billion.
Yeah.
And that's a lot. That's one of the biggest fines of a company received by a judge in the US.
In the States, yeah.
And the market didn't respond, or the share price didn't respond that much on it. It went down a little bit, but not directly.
No.
So I think that was an important one. NIO, they announced figures over 2020. And they were good, but the outlook is not that good. And the share price already, if you're talking about share prices going down, they already went back from $60 to $40.
Yeah.
That's quite something.
Tremendous, yeah.
And also Lufthansa, it is the biggest airline company I think of Europe.
Yeah.
They also had some figures 2 days ago. And they also had, of course, a bad year and a bad last quarter. But, to place it in perspective, they lost in Q4 10 million euros on a daily basis.
Yeah, that's insane. That is insane.
And also they expect in 2020 that they will lose money.
Yeah.
And China came with their estimations on Friday morning.
Correct.
The market was hoping on an economic growth target of 8%, but it was only 6%. So the market was not really positive about that. And they also said that it was quite interesting. They're going to increase their R&D budget with 7%.
The government in itself.
Yeah, the government. Okay. But also they're going to increase with almost 7%, 6.8% their defense budget. So they're going to increase their army. But if you look, we talked about the US a couple of weeks ago, about that they don't have money on a government level to do something about development, about R&D. So it's quite interesting to see at this moment that that the Chinese government has decided to increase the R&D budget.
I read in the newspaper, you possibly have seen it as well, and in The Economist, that the US debt in 2051 will be over 210% of the GDP. Those are with the package of Biden, the 1.9 trillion.
Yeah.
I mean, where are we going with this debt?
But that's also the answer.
Yeah, that's actually the answer. Yeah, you're right.
You were saying the question: which shares should you have in your portfolio when market's going down?
Correct.
And it's quite people think, if there's going to be a crisis, people go to the supermarket. Normally, in normal situations, you also go to a bar. So the normal things they will follow. But in general, you can say, so we had a lot of questions this week, also the week before, markets are going down. What should I do? What
Yeah,
should I
yeah,
do?
yeah,
So
yeah,
then
yeah.
one of the solutions, you have other solutions. One of the solutions is that you look at your portfolio and that you focus on debt positions.
Yeah.
So you focus on companies with relatively or absolute low debt
Yeah,
positions.
yeah, yeah, yeah.
I spoke first one step back. In a society, you have four kind of debts. One of them is the government debt, what you just mentioned. Then you have the debt of the banks. It's also really important. The debts of private persons, and the debts of companies. Now, in this case, we want to look a little bit at the debts of companies on a company level, and then you can, of course, people talk about debt in general, absolute, but it's not that important. It's always relatively, of course. Short term versus long term, and then debt ratio, equity is really important, and also debt versus cash flow versus income. And I spoke a couple of weeks ago about Google, because they presented the figures. So I also looked at the debt position, and I want to give two examples. First, one step back and go again and look at the debt position of Alphabet, because it's a tech company, and a lot of people in the market say, the tech companies, they have a lot of debt positions. But it's not always the case. Maybe it's even the opposite. If you look at Google, so Alphabet, the mother company, then you see they had in 2020 183 billion of revenues, 61 billion of EBITDA, and a net income of 40 billion. 40 billion net income. And their total debt is 26.
Okay, that's not bad then.
That's not bad, no. So that is really an important one. And if you look at the debt capital ratio, it's 0.1. And you see the same figures, not that positive, but you see that also with Facebook, Tesla, and Apple. But that's really that people should aware of. So
100%.
If they think that markets go down and they want to make a shift in their portfolio, look at from
different perspective.
And what I also did, I used my screener, and I did a couple of things.
Very special screener.
Yeah, I went back to the S&P 500. Then I selected the tech market, because everybody's talking about the tech market.
100%. This morning I had a client with a very large position in tech, and he's really, what can I do? Should I step out? Should I stay? And
so I made the first selection S&P 500, the second selection really the tech. So I didn't do the Nasdaq, but I did S&P 500 and tech. Then I looked at the debt ratio, long-term debt versus equity lower than 0.1, and I did it before the long-term debt ratio, the total debt versus equity under the 1. I hope that everybody understands it. But I did something else. I made an EPS, earnings per share, growth for the last 5 years bigger than 5, and also for the estimations for this year also higher than 5.
Yeah, so you have a positive outlook basically. So the company's income is increasing.
It's
earnings is in a growing trend.
From the past and in the near future. So that's what I did. And I also incorporated a little indicator, the RSE. We spoke about it. You spoke about
relative
it.
strength.
And then I selected the 30. So then you look at
oversold stocks.
Yes. And 2 stocks came up.
Now you're going to hopefully tell us what stocks that are.
One of them was Salesforce. The other one is Arista Networks. Arista Networks. And I dove one step further into Arista Networks. I looked at the revenues, 2.3 billion over 2020, EBITDA 780 million, net income 635 net income, and a total debt of 72 million. Then
Sounds pretty good to me, yeah?
Sounds pretty good. If you look at it from a debt position. Of course, you must look at the company if you believe they are in hardware and in software. And hardware is always a little bit more risky than software nowadays, but besides that. Then I looked at the price. So in November they were still trading at $200, then they jumped to $300, and they're now around $270. You see on this chart, you see this, it's hitting a level at the top of the July 2020.
Okay.
And if you look at the analyst, the consensus, the lowest one expects in 1 year $295. So back again,
270 something.
it's 271. The lowest estimation is 295, and the highest one is 411. So then you
Wow.
are talking about the big players in the market with their estimations.
Well, it's a nice consensus, I think.
Yeah.
Yeah.
And of course, maybe it's risky because they're more in hardware. You have to look into the company. But from a debt perspective, if you you follow those steps, and if you want to more about how we do it, then you can always reach out to us.
Yeah, it's
and
a
we
very
can help
interesting
you.
approach, I think.
Yeah.
Very good.
So if you think the markets go down, look at your stock or your portfolio and look at it from a debt perspective.
But also you have to bear in mind, I think a simple rule is that I think also when you take shares, you're also owning that debt.
Yeah.
So if you have $270 per share, some amount of that is debt, and this is very little.
Yeah, that's very low. Yeah.
Yeah. Well, on a request of a very good friend and client of us, I checked the real estate sector.
Okay.
And I did a little bit of a different approach. I did a screening search, so in the platform I went in the screener and I searched for obviously industry real estate, and then I looked in subsectors: real estate development, real estate diversified REITs, so the real estate investment trust, and I looked for offices, residential construction. First of all, what is a REIT? Basically, it's a basket of shares in the real estate sector. And very important to mention that in 2020 they had a really bad performance overall. It's a very common way to invest in the United States. If you have a global overview, what did very well in the real estate industry, that was home building, especially the home building ETFs. They outperformed the markets. What did I do? I made a selection on price earnings below 20. And I looked at companies with a market cap above 10 billion. Obviously then I also, because we're Dutch, I looked specifically in the Dutch market, because we have quite a chunk of large real estate companies or building companies or shopping mall owners. I did a little bit of a down step to 1 billion, otherwise there were no companies. The majority of them are around 500 million worth of valuation. I had another approach. What I did is I checked the total long-term debt of those companies, because of course that is saying how much mortgage they have basically on their portfolios. And what I found very interesting, specifically looking at the 5 largest Dutch companies, that there was only one, which is called Nieuwe Steen Investment, that had less long-term debt than the market cap. So I'm not going to mention you all the figures here, but of course, what is it saying? The long-term debt versus the capitalization is an indication that shows the degree of financial leverage. You know how and of course the market cap of the company is important because the more value is in the stock, then that will be more favorable, and it shows actually the proportion of the long-term debt those companies are using to finance their properties. One of the largest ones is China Vanke. Has a market cap of nearly 60 billion, and they have a long-term debt of 27, so it's more or less half, which is a pretty good ratio. In Germany, we also have an interesting company, which is Deutsche Wohnen, and the majority of those activities are in residential buildings, but they're suffering because that's also a risk of this sector. They're suffering because they're very active in Berlin, and they have a restriction on how much they can charge on a monthly rent. You know, there's a lot of, like the same thing I was watching last night on TV in Barcelona, people that are owning apartments. There's a lot of restrictions from the Catalonian government on resident of tourism, that you can rent out your apartment short term, etc. You have to pay very high licenses, etc. They make it nearly impossible. Just a few tips. Avoid high payout ratios. So when the funds from operations, so what they're actually bringing in, are smaller than what they're paying out, you should be careful, because then the money comes from somewhere. They could even take another loan to maintain you as an investor happy. And also be careful when they have a very high interest expense, because of obviously that is a sign, it's an indication. And what is a good rule is that when the debt to EBITDA ratio is below 6 for real estate, then that is reasonable. Homework. I found 3 companies that I think is interesting just to in the US to have a look at. 3 stocks. It's WP Carey. They have a very wide range of different real estate investments. So first of all, part of industrial, warehouse, office, and retail, 25, 25, 25. So very well diversified. And they were capable also to maintain the occupancy rate high last year, but also to, but that's very important with these companies now.
The income.
The income, they generated 85% of their rental income, so that is important. Federal Realty, also a US company, they have 100 retail centers. The yield on their portfolio is 5%, and they also have they managed to get 85% of the income in. And the last one is Simon Property Group. So if you think that everybody in the US will go back to the mall, they have very well located malls, 200 malls in the US, and also managed to get 85% of their income in. So interesting, I think, to have a look at those companies.
Yeah, because it's an asset class.
It's an asset class,
and real estate is an important one.
Absolutely.
So from that perspective, it's really interesting. Thank you. Okay, that was quite hot. What's next? Today, the unemployment figures in the US are coming out later today.
It's an important one.
Yeah, it's an important one. The 9th of March, Basic Fit will come with the figures.
Okay.
Basic Fit. We can look how fit they are. They have also the gym organization. They have also they are in Barcelona, I think.
Yeah,
Malaga.
I think
in Germany, a really big gym company. And they are closed, of course, for a couple of months already. So it's really interesting to see. The 10th of March, the biggest company from Spain will come with figures. Inditex.
Inditex. I don't think if it's Santander or if it's.
Oh, that's really good sign, of course. So that's the 10th, and the 11th. The ECB has its meeting. Also, from a more macro perspective, it's an important one. So that's and I closed down last week with a question because I spoke about Adidas versus Nike, and then I asked, what kind of shoes am I wearing? So I already said I'm wearing Adidas or Nike, and I think we had a 100% hit ratio. I don't know why, but I was wearing my Nike sneakers.
Well, my father said you were wearing Adidas, so.
he didn't tell me that.
No, he told me and I didn't tell you.
And you also didn't tell me that.
So it's 99.9%.
Okay, now thank you for watching. Please give the, I have...
you got yourself, but give us a big thumb up. It's important so that the people can find us. And thank you for watching.
See you next week. Bye bye.